Hello and welcome back to India Business Insights. Today we're going to have a look at the economic laws and regulations in India for foreign investors. In the first part of this video, we saw the kind of entities a foreign business may register in India and also discussed various provisions applicable to companies. We also briefly saw the laws applicable to expatriates in India, particularly relating to visas and personal taxation. In this video, we'll see the major economic laws and regulations applicable to be various business including foreign businesses operating in India. We have also done several detailed videos. I suggest that you browse through the other videos on our site and in particular the business and economic laws playlist where we are currently having over 60 videos. Before we start, I urge you to subscribe to our channel and hit the notification bell to stay updated on our latest videos. Let's start with the Indian Contract Act of 1872. This act is now the cornerstone governing the formation, execution, and conclusion of contracts. Picture it as the rule book ensuring agreements are not just made but also legally enforceable. Now, a contract isn't just a simple handshake, it's a carefully crafted agreement that must meet some essential criteria. We are talking about the free consent of parties, ensuring everyone involved in legally competent, having a lawful consideration, and a contract with a lawful object. Plus, it shouldn't be expressly declared void by the ICA. But that's not all. The ICA goes beyond the basics, dealing with special contract types like indemnity, guarantee, bailment, pledge, and agency. Yet, it leaves room for separate legislations to handle contracts like partnerships or those related to the sale of goods. Now, let's shift gears to intellectual property rights, an area where India plays by the global rules set by the GATT and TRIPS agreements. First up, copyrights. Governed by the Copyright Act of 1957, it protects the rights of authors over their literary, dramatic, musical, and artistic creations. The catch? Copyright is automatic. Registration is a choice and not a must. The Trademarks Act of 1999. It ensures protection for trademarks related to services and goods. Remember, registration is crucial here. Prior use isn't a prerequisite. Ever wondered about the geographical indications like champagne or Darjeeling tea? India's got it covered with the Geographical Indications Act of 1999. This law safeguards goods linked to a specific region, tying their quality or reputation to that geographical origin. Next in line, patents. The Indian Patents Act of 1970 regulates the grant, revocation, and infringement of patents. Infringing a patent? That's a punishable offense under this act. Lastly, let's talk designs. The Design Act of 2000 steps in to protect unique designs applied to a specific articles commercially marketed for a set period. India's antitrust regulations. These laws help to keep the marketplace fair and competitive. First up, we have got the Competition Act of 2002. This act helps to promote competition, protect consumer interests, and keep the trade playing field level. Meet its sidekick, the Competition Commission of India or the CCI, ready to tackle any anti competitive practices or mergers causing a stir in the market. Next on the stage is the Consumer Protection Act of 1986, a shield for consumers against defective goods, deficient services, or any unfair trade practices. It's all about putting the power back in the hands of the consumer. Now, let's talk about the Arbitration and Conciliation Act of 1996. This law is the go to guide for resolving disputes through arbitration. It lays down the rules for appointing arbitrators and ensures the enforcement of arbitral awards. Spoiler alert, parties better agree because this act is the boss in agreements with arbitration clauses. Let's talk about the Negotiable Instruments Act of 1881. This act is important when it comes to promissory notes, bills of exchange, and checks. Get this, it even dishes out criminal prosecution if there's any funny business with encashing negotiable instruments in India. Last but not least, the Sale of Goods Act of 1930. Consider it the ICA's partner in crime, covering the nitty gritty of offer and acceptance, legally binding agreements, and mutual consent. Labor and employment laws in India. Labor matters in India fall under both the central and state jurisdictions. Yep, it's a dual setting where both the big bosses at the central level and the local heroes are at the state level can make the rules. India is on the verge of a major labor law change. Why, you ask? Well, it's all about recognizing that the country's economic growth relies on top notch labor laws that balance social equity, security, and business ease. Four brand new central labor codes are in the works, covering wages, social security, working conditions, and industrial relations. Crafted based on International Labour Organization standards and with input from various stakeholders, these codes are set to replace 29 existing central labor laws. Residential permits and taxation for foreign nationals in India. If your visa is beyond the 180-day mark or gives you that special registration wink, you've got 14 days to approach the local FRRO or FRO. And for certain VIP visitors, they've got a backstage pass to register with the police authorities. Income tax depends on your residential status during the tax year. We've got a nifty table of conditions to figure out if you're a tax resident or not. Family and personal considerations are included as well. But wait, there's more. Social Security. The EPF Act takes the stage, covering establishments with 20 or more employees in specific industries. Even smaller crews can voluntarily join the EPF Act party. Employees get ready to groove with contributions to provident funds and pension schemes, including our international worker friends. Financial reporting and audit requirements in India. All companies listed on the stock exchange and non listed companies with a net worth of INR 2.5 billion, including their holdings, subsidiary, joint venture, or associate companies, must prepare financial statements following the Indian accounting standards. Companies, including body corporates, are required to uniformly adopt a financial year ending on March 31st. However, a company that is a holding or subsidiary of a foreign incorporated company following a different financial year for global accounts consolidation may seek approval from the National Company Law Tribunal or NCLT for an alternate financial year. The application to the Indian accounting standards to banking and insurance entities have been deferred by regulators, and the timeline for implementation will be separately notified by the respective regulatory bodies. Indian accounting standards is applicable to both standalone and consolidated financial statements. Companies falling below the net worth or threshold of INR 2.5 billion can voluntarily adopt the Indian accounting standards or continue preparing financial statements under the accounting standards notified in the Companies Accounting Standards Rules 2006. Once a company opts for voluntary adoption of Indian accounting standards, the decision is irrevocable, and subsequent financial statements must follow the Indian accounting standards. All companies must undergo audit by a practicing member of the Institute of Chartered Accountants of India, and the auditor's report should be attached to every financial statement. Under the Companies Act, auditors are appointed for a term of 5 years. Listed companies and those in a prescribed class cannot appoint or reappoint an auditor for more than two terms of 5 consecutive years for audit firms, or for more than one term of 5 consecutive years for individual auditors. India follows the convergence approach. Rather than fully adopting international financial reporting standards issued by the International Accounting Standards Board, consequently, financial statements prepared in accordance with the Indian accounting standards may not be entirely compliant with the IASB or IFRS. Direct tax in India. Income tax in India is imposed by the central government, administered, supervised, and controlled by the Central Board of Direct Taxes or CBDT. For Indian income tax purposes, a corporation's income comprises various heads, including income from house property, business, capital gains on the disposition of capital assets, and residual income from non business activities like income from other sources. Corporations resident in India are taxed on their worldwide income from all sources. Non resident corporations are taxed on income earned through a business connection in India, any source in India, or the transfer of a capital asset situated in India. The term business connection is used in the India Income Tax Act instead of permanent establishment in tax treaties with a broader scope. Under the Double Taxation Avoidance Agreement or DTAA, the provisions of the Income Tax Act or the DTAA, which is more beneficial, apply to non resident taxpayers, potentially restricting or modifying taxability. The Indian tax year runs from April 1 to March 31st of the subsequent year. The due date for filing the return of income varies based on categories, with non resident corporations also required to file ROI in India under specific conditions. Effective from April 1st, 2022, taxpayers can file an updated ROI to correct errors in computing tax liability subject to conditions. Corporate tax liability is estimated and discharged quarterly through advance tax payments. Late filing of ROI and delays in payment or tax shortfalls incur penalties and interest. Manufacturing and electricity generation companies established after October 1st, 2019 and commencing operations until March 31st, 2024 can opt for a concessional tax rate if they forego the specified deductions or incentives. Domestic and foreign corporations are subject to a base tax rate with variations based on total income, surcharge rates, and a 4% health and education cess on the tax payable. Depreciation. Capital assets are subject to depreciation through the reducing balance method, employing variable rates based on the nature of the assets. Tax on dividend income. Taxation on dividend income involves the taxable treatment of dividends received from domestic companies, with interest expenses up to 20% of the dividend income being deductible. Dividend distributing companies are mandated to withhold taxes at applicable rates. Tax on virtual digital assets. A distinct tax framework has been introduced in India for virtual digital assets or VDA, encompassing cryptocurrencies, non fungible tokens, and assets designated as VDA by the CG. Income from VDA transfers is taxed at 30% from April 1st, 2022, with no reductions allowed except for the cost of acquisition. Gifts of VDA are also taxable for the recipient, and consideration paid for VDA transfers to residents is subject to a 1% withholding tax from July 1st, 2022. Losses from virtual digital assets or VDA transfers cannot be offset or carried forward. The gains made from trading cryptocurrencies are taxed at a rate of 30% plus 4% cess, according to the Section 11.5 BBH. Section 19.4S levies 1% tax deducted at source TDS on the transfer of crypto assets from July 1st, 2022. If the transactions exceed rupees 50,000 or even rupees 10,000 in some cases in the same financial year. Relief for losses. Companies engaged in businesses are required to maintain books of accounts and undergo tax audits if their total sales exceed INR 10 million or INR 100 million with less than 5% cash transactions. Business losses can be set off against other income in the same year, and unabsorbed depreciation can be carried forward indefinitely. Books of accounts and tax audit. Non residents are taxed on capital gains from shares of interests in foreign entities with substantial assets in India. Small shareholders holding 5% or less are exempt from indirect transfer tax, and certain conditions apply to the tax treatment of shares in Indian corporations resulting from foreign mergers or demergers. Double taxation avoidance agreements or DTAAs govern the foreign tax relief. Authority for Advanced Ruling. A scheme for advanced rulings is accessible to provide clarity on the income tax obligations for eligible taxpayers, including non residents. This allows for proactive income tax planning and helps in avoiding prolonged and costly legal disputes. Applicants, whether residents or non residents, can seek a ruling regarding any legal or factual aspect related to the non resident's tax liability arising from a completed or proposed transaction. Additionally, resident applicants can approach the Advanced Ruling Authority for determining the tax liability in transactions with non residents, especially those valuing INR 1000 million or more in aggregate. General Anti Avoidance Rule or the GAAR. The General Anti Avoidance Rule addresses impermissible avoidance arrangements, denying tax benefits if the main purpose is tax avoidance. The GAAR provision don't apply if the tax benefit doesn't exceed INR 30 million for all parties in a relevant tax year. Relief for losses. Except for losses from speculative businesses, business losses can be offset against income from any source, excluding employment, that is, salary income, within the same year. If not fully offset, these losses are allowed to be carried forward for up to 8 subsequent years, and absorbed depreciation is eligible for indefinite carry forward. Indirect transfer of shares of domestic corporations. Non residents are subject to taxation on capital gains from shares or interests in foreign companies or entities registered outside India, provided their value is substantially derived from assets in India. This applies when the fair market value or FMV of an Indian asset on a specified date exceeds INR 100 million and represents at least 50% of the foreign corporation's total asset value. Small shareholders with 5% or less total voting power or share capital in the foreign corporation or entity directly holding Indian assets are exempt from indirect transfer tax. Additionally, the indirect transfer of shares of an Indian corporation as part of a merger or demerger of foreign corporations is not taxable, contingent upon meeting specified conditions. So, there you have it, a summary on India's legal and regulatory landscape for foreign investors. Keep these points in mind and you'll be better prepared for your Indian business journey. Don't forget to like and subscribe for more Indian business insights. I wish to again remind that this video is not a replacement for professional advice. This is only for informational purposes. Many of us are chartered accountants and lawyers. We also have a panel of